this is the annual salary review we're going to cover first before we get into the, the PowerPoint and the concepts and things you need to know. I want to do a review of salary structures and share my screen with Excel. In the handouts you've received, in addition to the PDF with the slides, you've received a few Excel files. And one of them is a file that I've created strictly for teaching. It has fake employee data, fake market data, survey job matching, pivot tables, charts, graphs, everything for developing salary ranges. And I want to just take you through that. I actually teach a one-day Excel for compensation course. I used to teach it in 2 days, but I included hands-on skills in job evaluation and some other areas. But I have a one full day Excel class that I run. I'm going to give you guys the 1 hour version of it. And just, if it's been a while, or if you have not actually created salary ranges using Excel, I'm going to show you how I do it for clients when they want it to be done right. We all join a company and the ranges, you inherit the ranges. It's like, oh, these are the ranges. How did they get developed? How did they get calculated? I don't know. We just inflate the ranges every year. So I'm going to go through, the most common sense way of calculating them. And then we'll get back to running the salary review, because in the salary review, we really rely on 2 variables. One is each person's performance rating, and the second one is their compa ratio, their position within the range. 95% of companies will guide managers on the merit increase amount based on those 2 factors. So I want to show how we develop salary ranges, because we need those midpoints to calculate compa ratio. All right. And then that'll become very obvious once we get into the salary review and we start using compa ratio. Okay. So okay. Do you see the Excel?
Yes.
Okay.
Yes, we can
Great.
see.
Okay, so this is fake data. I just have some names here, gender, I have titles. And based on the title, these are formulas over here, which pull in the grade, the function, and even the job evaluation score. I use Patterson. So in Patterson job evaluation, you may have heard of it, invented by a Scottish professor, and it's public domain. It's quite popular in Europe, Middle East, and Africa. Other regions have never heard of it, but there's a lot of companies that have heard of it and use it in those other regions. Welcome, Tasnia. We're underway here.
Yeah, sorry, I was being late, sorry.
No worries, no worries. Things happen. So we're doing fine.
Okay.
So in this sheet, we have Patterson grades. And so band F is like the CEO. It's the head of the organization. And there are different levels of F depending on the size of the company and some other variables, factors. E, 1 through 5, there's E1, E2. I'm going to reduce the size of this a little bit so you can see it better. E1 would be, strategic function head or business unit leader on the low end, okay? E2, E3, E4, E5, these are, heads of major functions, or head of operations, or head of all administration, or CFO, something like that, okay? D in Patterson would be, generally speaking, department heads, and there's D1 through D5. and managers and department heads, more or less. And they develop policies which people at lower levels work within. Okay, policies, procedures, methods, systems. They develop these things for their area, and then people at lower levels, which are C levels, C would be the specialist. A C4, C5 is a highly experienced professional, maybe requiring a master's degree, or at least working at a very high complexity kind of work. So you have senior engineers and this kind of thing. A C2 or a C3 could be an early career professional. All right, C1 might just be like a technician. And then B jobs, here you can see B, B3, B4, these are support roles, administrative assistant, customer care, and so on. So that's the Patterson level system. If I change this title to cost accountant, the grade will change to 11. It's finance and accounting, and it's a C3. If I move it back to chief financial officer, the lookups will pull this up. Where are they getting this information? They're getting this from the jobs tab. So this is my job catalog. Every company should have a job catalog. I think, Layla, you would know this because when doing HR administration, you need to really define each available job classification. And that job classification is associated with a job description, which I've summarized here, but you have, real job descriptions, perhaps in Word or some other form. And we evaluate those jobs looking at the job description using Hay or using Patterson or using Mercer or Willis Towers Watson, but some kind of job evaluation system to come up with the size of that job. And then that's usually the basis for grading the job. So here's the functions. If I filter here on human resources, you can see just the jobs that are in HR, going from grade 15, 14, 11, all the way down, and the corresponding job evaluation levels. So companies have these kinds of tables. This would be usually called a job table or a job classification catalog, or simply job catalog, right? You go to a restaurant and you cannot just ask for grandma's spaghetti, right? If it's on the menu, they'll make it for you. If it's not on the menu, they won't serve you that food. So we need to have a menu of job titles in our companies. And within each function, for example, HR, we would want to know, top to bottom, what are the job classifications available within HR? And from time to time, we create new classifications. All right, because we try to avoid proliferation, the endless creation of new job classifications. So we want to keep a lean job catalog and limit all employees to be assigned, or their position to be assigned if it's vacant, to one of these job classifications. And this is the correct spelling of the title. So you'll notice here, I cannot type CFO. And then when I hit enter, I get an error message because I have data validation restrictions. Okay, I'll hit cancel. If I go to data, there's a separate menu. I go to validation. You can see that the values in that cell are being limited to a certain list. And where's the source of that list? It's called job titles right there. I know it's very small. So what is the job titles list? Well, within Excel, you can name ranges. I don't use dollar signs in my formulas anymore. I name ranges. You can see all the named ranges in the name box. This thing over next to the formula bar is called a name box. So if I click here, you can see a lot of named ranges. So if I click on job titles right there, I click on it, Excel is going to jump to the jobs table. Hang on. How come that didn't happen? Let's try this again. Go to job titles. There we go. It jumps to the job catalog and it highlights all of these titles. And if I unfilter function, yeah, it highlights all the titles all the way to the bottom. You can set up a named range and use it within your data validation, like right here. All right, how do you set up the name job titles? Well, you can just highlight the cells and then go to the name box and type name and then hit enter. And now if I'm over here and I pick name, it jumps over here. So you can use this list as a pick list, the source for a data validation pick list. Now, I don't really want this one because I'm only demonstrating how to name a range. You can go to formulas, name manager, this little section here, and see all the named ranges. And name is the one we just created. I'm going to delete it. I want to delete this, yes. Okay, close that. Now I look for a range called name, it's not there. All right, so there you go. I have the whole job catalog is named. If I click on that, it will highlight this whole thing. So if I know a title, I can then go over using a lookup formula and pull some information over here. All right, so this is just kind of some Excel skills that are important to use. Why? Because we don't want to make typos when we prepare reports, right? Have you ever prepared a report and somebody found an error in it because a job title was misspelled or a location was misspelled? This is why I use data validation, because, you know, I never catch my own errors. My subordinates never catch my errors. My boss never catches my errors. It's always the CEO. It's only that one or twice times during the year when I once or twice make a report that goes to the CEO and the CEO says, hey, that's wrong. And we work hard, and one error in the report sets our career progress back about 3 months, doesn't it? So I don't trust myself to enter anything accurately. So if the title CFO exists here, right there, then I'm going to pick it off of a list. I'm not going to let myself type it in because I just know I'm going to misspell it. Maybe I'll put an extra space at the end, and that's going to mess up something. It's not going to work when I have formulas. Okay, so that's just organizing employee data. It's quite typical that an employee or their position is classified to a job which has a grade. It's part of a function. It's got a job evaluation under it. It may have a benchmark value associated with it and a job description. So this is the job title that we assign to people or to their position if we're using position control. Position control is a capability in an HR system to track vacant positions. So you can actually have a more accurate headcount report, and you know everybody's boss and their boss and their boss and their boss, even if there's a vacant manager position, because the positions report to other positions. It's not dependent on being a filled position. Even vacant positions can be evaluated and have a reporting relationship. So position control is an ideal feature, in my opinion, in an HR system, but it does take some work to set it up and maintain. Okay, letting Nobi back. All right. All right, let me move on. So we have people's salary here, and that's all good. This is monthly salary. And I'm sorry, these do not look like Bangladesh Taka, perhaps, but anyway, this is just for teaching purposes. I use this file for, for these certifications, regardless of what country people are in. Okay, the employees data is here. The jobs data is here. Now I have market data. Market data is usually obtained from the big survey publishers, Mercer, Willis Towers Watson, Aon, Korn Ferry, and a few others. The surveys always give us a means of finding the match. So here we've filtered on finance and accounting. I could filter on operations if I wish, and I'll see operational job titles. These are the survey's job titles, not my company. And the surveys may have like a job code. In fact, they almost always have a job code. You can sort and filter survey jobs by function or by level. Here, I've conveniently shown the job size using Patterson so that I can show you how we match jobs. So we have jobs such as these jobs in finance and accounting. Oh no, these are grade 11 jobs. Let me unfilter this. Okay, so here are all my jobs. Within finance and accounting, we have chief financial officer. The Patterson level is E3. And the survey has a job that is a good match. I'll show you where it is. CFO level E3. So if I go to my market data, there is under finance, let's go to finance. There's head of finance, E3. Now it doesn't say chief financial officer, it just says head of finance. That's okay. I wouldn't match based on the survey title and my title. But I would read the brief description of, my job. I would read my own company's job description, make sure I know what that job is. And then I would look at the survey matching guide. Usually the big surveys, the good surveys will give a matching guide to help you match apples to apples, oranges to oranges, and so on. So this looks like a pretty good match. It's the top position over finance. And the Patterson level is E3, which is consistent with the job size in my company. So in the survey matching, I would go here and pick job 2001, and it will bring in head of finance. It'll show the Patterson level so that I can see that it's a good match with my own internal level. And a lookup formula will pull in the market median salary, and it's aged. So I'll show you in a moment how I age the data. But I use the survey job code as the basis for this lookup formula. Okay, all of these are using this job code match in my lookup formula to pull in the value. Any questions or comments so far? I'll just keep going. I think you guys know what I'm talking about on all of this stuff. Okay, now, where did this aged median market salary number come from? In the market data, surveys will give you annual data because some companies may pay 12 months of salary each year. Others may pay 13, others may pay 14. I don't know what's typical in Bangladesh, but in Malaysia, in Singapore, companies vary in the number of months of salary that they pay. In Japan, companies may pay 12 months, they may pay 13 or 15 or 16 or 18 or even 21 months, I've heard of. And so it's, you cannot have a survey reporting monthly salary when companies have different number of months that they pay. So what they give you is they give you annual salary. And then if you want to convert it to monthly, you can do that by dividing by the number of months that you pay at your company. And then you can get a monthly salary. But the survey numbers are always annual. Okay, so these are the survey median monthly salary. Just a reminder, we use median, not average. So if I can just briefly unshare, and if you look at my fingers, I use my fingers to teach sometimes. Let's say these are salaries, 4,000, 5,000, 6,000. 4,000, 5,000, 6,000. Okay, the average is 5,000. This is 4,000, 1,000 less. This is 6,000, 1,000 more. 4, 5, 6. Average is 5, right? And what's the median? 5. The median is the middle number. So there are just as many values above as below. It's the middle number. So 5 is the median, 5 is the average. Now, in many companies, there are certain individuals who, for various reasons, make a really big salary, okay? It's not going to be 6,000 at the top. It's like 8,000, really high, okay? You know who they are. Here and there's somebody who's very special. They used to run a bigger, department or region or country or something, and they wanted a less stressful job, so they voluntarily took a downgrade. But what do? Sometimes we grandfather the salary. We don't reduce the salary, but their salary grade is now lower. Okay, so their salary made sense in the old job, but now they're in a lower salary grade, so they're over the max. So these data points are sitting in the same survey database as, I would say, normal data points, right? So this 4, 5, 6 is really not 4, 5, 6 all the time. Sometimes it's 4, 5, 8. So the median is unaffected by this situation. 5 is still the middle number. It's a stable number. It's not dependent, okay? It's not altered just because the high number here and there is really extreme, okay? So the median is more stable, whereas the average, if this one goes from 6 up to, let's say, 9, then you have 4 plus 5, that's 9, plus another 9, that's 18. The average is 6, but the median is still 5, but since this is 9, the average is actually 6. So which one do you use? Well, this one is skewed because of this high outlier. I don't want to use an average of 6. I want to ignore this one. I just want to focus on the median number. It's a more stable number. Okay, good. Hope that makes sense. Intuitively, we might say, what's the average salary in the market? But honestly, in the comp and ben practice, that's not what we do. We take the median from the survey. Okay, does that make sense? Any questions on that?
No questions.
No question.
Okay. Okay, very good. All right, now.
Tom, I have a question.
Yes. That's not.
Yeah, I have a small question. So, it's about aging, the aging median data. So, how do you do that?
How do you age the data? I will explain that right now.
Yeah.
Okay, so good timing, good setup. Okay, I'll just go into aging now. So aging is necessary because by the time you receive the survey report or you get the download from Mercer or whoever you use, the data was collected by that survey publisher last April in most cases. And you're not able to download the data until October. And then you're going to use that data to calculate new salary range midpoints for the coming year, starting January and lasting through December of the coming year. So the data was collected from participants previous April, but it has to be in effect for the full year of, that hasn't started yet. So we don't want to pay people too low. It makes it difficult to attract and retain. So we want to age the data. So that's why we do it. to make sure that the salary ranges and pay decisions that refer to your market data are well informed. You're making those decisions with respect to an estimate of the current market value, or the market value at the start of the year, or you may want your salary range midpoints to reflect the market as it will be at the end of the year. So you can lead the market and age your market data to the end of the coming year, all the way to December. You can sort of inflate the market data to the end of the coming year. Many companies will inflate the market data from April last year up to January, the start of the new year. That's lagging the market. Even though you've inflated the data, you've aged the data, that's still going to lag the market, because that salary range midpoint and range will be in effect from January to December. And during this time, the market is moving up, but your range is in effect. It's not changing during the year. It's just in effect January to December. But the market, you know, from where the midpoint is, keeps moving. So if you see over here to the right, let me share my screen again. Okay. If you age your data to the start of the new year, 1st of January, you're still going to lag the market. Once you get past January, your range is not going up anymore, but the market keeps moving up. If you age your data to the end of the coming year, you're going to lead the market all year. Okay, so in January, your midpoint is actually set to where the market's going to be at the end of the years, because you've aged your market data to the end of the coming year. So in that instance, you're going to lead the market until December. Another approach is lead lag. This is where you age the data to the middle of the coming year. You age it to 1st of July of the coming year. All right, so you'll lead the market for the first half of the year, and then you will lag the market as the market moves beyond your midpoints. So this is called taking a lead market posture or a lag market posture. Okay, so yeah, there's a technical term for it there. So we want our market posture to be leading the market. Okay, some companies tried to be more competitive by using 75th percentile data, P75. But you don't have to do that, or use P60 or P65. You can do that. Another thing you can do that is less extreme and is easier to get approval, in fact, you may not even have to get approval, is just age your data more aggressively. Age your data further out into the future. Right? So if you're going to build salary ranges and you want these midpoints to be, you know, more, here's the midpoints. If you want the midpoints to be more competitive, you can age the data used to calculate your ranges further out into the future. Then the ranges will simply be higher. So what we do here is, back in the market data file, okay, we have to do some calculation. And here, I want to show this. We need to pull the data effective date from the survey. In your survey, it will publish the data effective date right there. And just look for it. That's the date when all the pay data submitted by the participants was in effect. It was true. Those were the salaries for people on that date. And as a participant, the survey publisher instructs you please report in your data submission salaries you pay to your employees as of 1st of June 2023, or whatever the date might be. I'm going to make this 1st of April 2024, and then I'm going to change this. Well, no, I mean, I'll make it match my example here. Okay, I'll just leave it as it is. But this one, I will make it 112025. That's what I'll do. 112024. I'll start with an easy example. Okay, let's say the data effective date was 1st of January 2024, and you want to age it to 1st of January 2025. That's 1 year. That's 1 year. This formula compares these two dates in Excel, and Excel calculates the number of days between two dates. And then you have to divide it by 365 to get the number of years. Actually, 365 and a quarter because of leap year in February. But let's say there's 1 year, okay? And the next big question is, what's the so-called inflation rate for salaries? Now, first point, this is not the inflation rate for fuel, housing, and butter or chicken. This is the inflation rate for talent. And so how do you do that? Well, just like you calculate the inflation rate for fuel and housing and chickens, you have to, here, let me unfilter that. You have to calculate what was the market median salary unaged in last year's survey, and then what is it in this year's survey. So these numbers that I'm highlighting right now come from here. It comes from this year's raw data. All right, and then I look at the previous year's data. Okay, and how much did it change? All right, went up by 5.9%, went up by 2.5%, and so on. It could even be negative. How can a survey median go down year after year? It can happen because maybe a high-paying participant chooses not to join the survey this year. Okay, a high-paying company was in the survey last year, but this year they're not going to join the survey. Okay, so the numbers go down because that high-paying company is not in the survey. So it is possible numbers can go down year after year. Many companies, when they see that happen, they say, we're going to wait 2 years before we make any changes. We're not going to make any changes because the number went down from here to here. We're going to wait till next year and see if it's still low. Some companies participate in surveys only every 2 years, just to save a little money because the surveys are expensive. Okay, but if you calculate the year-over-year change in a good set of jobs, a good sampling of jobs, then you can then calculate the average change year over year. And, you know, the jobs that you're comparing year over year, ideally, would be the jobs that you have matched to your company's jobs. I mean, what if your salary survey had nurses and you're not in healthcare? What if the salary survey has cybersecurity specialists, but you're not an IT company? Do you want your aging factor to be influenced by nurses and cybersecurity if you're not in healthcare and you're not in IT? So compare year over year for the jobs that you have matched to jobs in your company. Calculate year over year change and average it. And the average is about 3.5%, as you can see here, and you can see here. So I would just take that. This is just simply equal to this number here. That is the most direct, most common sense way to determine the aging factor to use. If you have year-over-year data, you can do it if it's a 2-year gap, but just make sure you do it sort of sequentially, exponentially. So the math is a little tricky, but if it moved 16% in 2 years, that doesn't mean 8% and then 8%. That means like 7.8 and then another 7.8, something like that. Okay, that's the best way if you are able to do that. Hang on. The other way is to find out what companies are budgeting. So there are surveys of companies in each country run by the big consulting firms like Mercer and Aon. And they ask companies, what are you budgeting for salary increases in the coming year? And if they all say, for example, 4%, which I use, as you can see here, for example, if companies are budgeting 4%, which is very common in Singapore, the year-over-year salary movement is likely to be only about 2.8%, 70% of the salary budget trend. This is true. Now, you might think that if everybody working in all the companies is getting a 4% merit increase, then the market is definitely going up by 4%, right? Wrong. If nobody changed jobs, nobody changed companies, then you would be right. And they all got 4%, then the market moves 4%. But in fact, people do change companies, people do change jobs. And when they change companies and when they change jobs, is it not true that they were experienced in their current job? They're not at the bottom of the pack. They're in the upper third of the market's pay for that job. And they're moving up into a higher level job and coming into that sample in the survey on the lower end, the lower half. Okay. When people make a move, they leave the survey sample from the upper portion of their old job, and now they're paid in lower in the range in their new job. Okay, so the sample for their old job, they're not in that sample anymore. This high data point goes away because they're not in that sample. They're in another job at the low end. And the next year for this job, as you move to the next year, all right, you had all 5 data points. One goes away. The others, they get a 4% increase. And then there's somebody coming into this sample somewhere in the low end who used to be in a lower job level. And so smaller data points come into the sample, bigger data points leave the sample. That's called slippage. Slippage explains why the actual year-over-year market salary change lags the average salary increase budget. If Bangladesh companies are budgeting 8% for merit, the actual year-over-year market movement is not 8%, it's 6.5% because of slippage. That's just how it works in the real world. People do not all stay with the same company, same job, year after year after year. If that were the case, but it's not, but if it was the case, and everybody got an 8% merit, then of course the market goes up 8%. But when you look at any particular job title, the sample is not the same year after year after year. Every year, some small numbers are coming into that sample as people promote up into that job, small numbers coming in, and then big numbers going away, year over year. That's called slippage. I have to confess, for many years, when I was aging my data, I would simply use the prevailing merit budget trend. If companies were budgeting 5%, I would age my data 5%. But it's actually not true. And that's good news. Have you ever told an employee that, don't worry if your salary is low in the range. Over time, you'll be moving up in the range. Well, look, if your structure follows the market, because your philosophy is to pay P50 median salary, if your structure follows the market and merit budgets follow that same market, then people would never really move up in the range because they're moving at the same speed as the range over time. But in reality, structures follow year-over-year market movement, and that might be 6%. Okay, that might be 6%, but the person gets 8. And then that's another 6% and the person gets 8. And yes, they actually start moving through the range because salary increase budgets exceed the actual rate of market movement because of slippage. That's good news because otherwise we're lying when we tell people that over time you'll move through the range. They would never really move up. They would just keep pace with the range.
Hi, Tom.
Yes. Hello.
Hi, we are here.
Can I say something about aging?
Yes. Go ahead.
So, in my case, in Honda especially, so we had a salary survey. So it was completed by November 2024. So
Okay.
I mean, the comparator salary maybe it was based on 2024.
Okay.
So meantime, the comparator salary keep moving, the market keep moving, and our new salary will be revised from April 2025.
Okay.
So I had the opportunity to watch some of your tutorials. So I got some lessons from for aging. So
Okay.
what I did, I mean, straightly to uh, age the data uh, by adjusting the directly inflation, so country inflation.
Oh, I see. Country, like consumer inflation. Are you referring to consumer inflation or salary inflation when you say country inflation?
Yes, yes. You suggested like to take 75 fifth percentile instead of to
50.
age the data. I mean the market median. So I did just to I mean adjust with the economic inflation, country inflation.
I
So is
see.
it I mean right or
Yeah.
I mean
There's really sort of no
in
right
scope to
and
improve?
wrong. There's no right and wrong, but I think that well, I can tell you that for the last 4 years, since inflation really increased in many countries, I've been running a survey on it's called Asia Pay Pulse survey. And one of the questions I ask is how is your company responding to increased inflation in many countries? And the number one strategy is to put a little extra money in the merit budget in high inflation countries. But they don't call it inflation budget. They don't call it inflation adjustment. In fact, they don't use the word inflation at all to label the increase or the budget because they don't want to set a precedent that the company's policy is to keep people whole with inflation. So what they do is the most common answer in that survey is to identify the high inflation countries. And even if the inflation is 8%, 10%, they don't add 8%. They don't add 10%. They add an extra, what's the salary trend? So the salary trend may be 6%, but instead of 6% salary increase budget, they'll do 7 or 8 or 9. They're not attempting to completely keep people whole with inflation. They're simply adding a little extra in those countries. That's the most common strategy reported in the survey of over 100 companies around Asia. But they're very careful not to promise or state a policy that the company will protect people from inflation, because people will remember that for 40 years. All right, and say, hey, the company has to keep us whole with inflation because they did that one year. So yeah, they're being very careful about that. You know, in other industries and in other, you know, in the economy, things that are tied to consumer inflation are usually things like Social Security benefits, Provident Fund benefits, and things like that. They may be tied to inflation to protect seniors from, you know, dropping their spendable income or their real income or something. But salaries generally don't behave that way. Most employers around the world do not inflate salaries mainly based on inflation. We're going to be switching to PowerPoint in about 10 minutes, and I'm going to go through the slides on what are the main primary considerations in setting salary increase budgets. And the top 3 reasons are not consumer inflation. Consumer inflation is the #1 secondary consideration. It's a secondary consideration because it does not actually follow business logic. It follows, it's a popular sentiment that the company's going to take care of me, but it actually does not follow business logic. Business logic is, we better budget more for this raw material because the commodity price is going up on that raw material, so we better budget. You know, the cost of eggs drives how much you budget for eggs. The cost of fuel drives how much you budget for fuel. So the cost of talent should drive how much you pay for talent. Okay, the market movement in talent should determine how much you pay, not the inflation of housing driving what you pay talent. It's 2 different things. Supply and demand of housing and food and clothing and gadgets, that determines the consumer inflation rate, but it's the supply and demand of talent that determines the market movement. And you could say inflation in the cost of talent. So that's the business logic, and that's the economic logic. However, people have to use their salary to buy stuff. Well, I would still say it's okay to tie pay to inflation, but do it every year. Don't just do it when inflation is higher than the salary trend. Example, in Singapore, the 5 years prior to the pandemic, 2014 to 2019, you can Google this and see it. The inflation rate from 2014 to 2019 in Singapore was 0. No inflation. But salary trend was 3.5% or 4%. So did any employee say, hey, I want to be paid based on the inflation rate? Nobody said that, because they would have had no increase in 5 years. But when the inflation rate goes beyond the salary trend, that's when they cry, hey, we have to be paid based on inflation. So, you know, like I said, you can do whatever you want, but be consistent about it. What the employees want is the higher of consumer inflation or talent inflation. Okay, they don't want the lower, it always has to be the higher one. So think about that for a bit. All right. So according to the survey that I ran, yeah, most companies really avoid suggesting or outright promising that they're going to keep people whole with inflation. But it's okay. I'm not saying it's wrong. I'm just saying if you're going to do that, then do it when inflation is like 0 also. So yeah, may not be the answer you want. Many people expect HR to be like the chief happiness officer, you know, keep everybody happy. Well, you don't want to have everybody leave and go form unions and protest, but you can also educate people. You could give your managing director, your country manager, talking points for the town hall and say, anybody here want to be paid at inflation when it's high? Everybody will raise their hand. And then you say, okay, now keep your hand up if you want to be paid based on consumer inflation when it's like really low, like 0 or 1 or 2, when everyone else is in the economy is getting a salary increase of 6 or 7 or 8%. You want to be paid inflation, which even if it's like 2 or 3, they'll put their hands down. Anyway, just thinking out loud here. That's the nature of it. It's a different thing. It's a different thing. We're buying talent. And how do you know the inflation in talent? Get your salary surveys and do a year-over-year analysis. It's right there. That's the inflation rate for talent. So that follows proper business logic, economic logic. The other one is more emotionally driven. And if they want it when it's high, they should take it when it's low. And then that's when they put their hand down. Okay, hope that helps.
Yeah, okay, thank you.
Okay, very good. Okay, I'm going to share my screen. We're going to finish the Excel stuff in the next few minutes, and then I'm going to go over to PowerPoint and just cover a few things. If we don't get to the PowerPoint, that's probably okay. We're okay to push it to next week, but let me see if I can finish the Excel stuff. Okay, so this is our aged median market salary. You can look at the formula here more if you like to. There's an exponent there and stuff, but that's what you have to do if it's multiple years or a partial year. But here you have your matching, and then it pulls in using lookup formulas. Now, if the match is no good, for example, you've used head of finance for your chief financial officer. But if you also have a VP who's a controller, they're in charge of the general ledger and the financial reports. But that's accounting. That's not finance. That's just the accounting side. Did you know that in finance, accounting, which is the financial reporting, you should have absolutely no creativity whatsoever, no innovation whatsoever. You should stick strictly to the international financial reporting standards and produce, truthful profit and loss statement, income statement, balance sheet, statement of cash flow. That's the job of the controller. Now, all the fancy finance work, raising funds, banking, cash management, currency hedging, managing tax, depreciation, amortization, all those things, that's treasury. So reporting to the CFO, let's say the number 2 person is the controller. And it's not an E3, it's an E1. And, but here we don't have an E1. We only have, we just want finance. There we go. Okay, there's no E1. It just jumps down to D4, and then you have some D4s. Well, you could use senior finance manager, but that's kind of low. What about D5 and then E1? It's 2 steps down. But let's say you decide that your controller is the number 2 person behind the CFO. And in Patterson, it's an E1 versus E3. What you'd like to do then, and you can do this, you can use the same match for both jobs. But in the case of the controller, the survey job for head of finance is actually too big. But it's still useful. Better to have a reasonable estimate of the market than to have no number. Maybe that's your point of view. So you want to have an estimated market value. So you're going to use head of finance again, but instead of using the same number here, you're going to take 20% off and use 17,881. All right. Now, where do I get the 20%? You can go here and look at the relationship between this number versus these numbers and, derive something in between or try to estimate. But this is a practice of premiums and discounts, which the HR consulting firms, I can tell you, do this for their clients when they do benchmarking. At least in the US, we did this. And our clients like Coca-Cola, UPS, and others were very happy to have a reasonable market number here. In this case, 17,881. It's reasonable to take this and subtract some kind of a discount off of it because it's off by 2 levels. E3 is 2 levels above E1. Now here's a case where you have a D1 job and the survey has a pretty good match, treasury manager, but in the survey, it's a D2, which is just 1 step too high. So what you're going to do is, you decide to take 10% off of that. This is something we used to do, and the clients were fine with it. I mean, there's no law against doing things when you're an analyst and you're trying to estimate market values. And a reasonable estimate of the market is more valuable than no number. At least that's the belief in many companies I've worked for. If you're in a company where using judgment requires you to justify and defend, how that is the correct way to do it, and okay, good luck with that. But managing comp is not like benefits. In benefits, everything's black and white. The enrollment cutoff date is such and such date. This medical cost is covered or it's not covered. We reimburse it at 80%. We don't reimburse it at 100%. Everything's black and white in benefits. All right. In compensation is not a black and white thing. Payroll is black and white. But comp, the determination of pay, unlike the delivery of pay, the determination of pay is not black and white. It's an opinion. 10 very smart compensation people will come up with 10 different suggested salary offers based on the candidate's strength, expected performance, relationship to peer salaries. We're constantly making judgments in the gray area, interpolating and so on. So what I'm showing you here, premiums and discounts, it's not a matter of correct or incorrect. It's a matter of having more matches than having no matches and coming up with a number that's reasonable. Sometimes you read the survey job and you read your own job description and you say, our job, okay, that's a good match. That's a really good match. But in this case, VP Finance versus Treasury Manager, ours is a VP. The survey just has a senior manager, all right? And it's only a D4, our job is an E1. I'm gonna add 10%. Okay, I'm just showing you a technique that we did in the US, and the big consulting firms do it and the clients love it. These other examples here, as I scroll down, were done by students of mine years ago when I taught this class over 2 days, and I delegated different departments for matching jobs, and they came up with these adjustments and they thought that they were, pretty reasonable. So I'm going to take these numbers in column J as my adjusted market value that I'm using for general benchmarking purposes and developing pay structures. So I would go here, and I'm just going to move quickly here. I'm going to go here, and I need a market value for my jobs. So I'm going to say equals V lookup. Actually, I use X lookup most of the time, but just to be quick here, I'm going to look up this in a range that I've named market values. And I'm going to go to the 8th column and put a 0 and pull in that number. I'm going to copy it down. Here's a job that was not matched, so it's blank. That's okay. Okay, but the rest of them, most of them have a match. Now the market ratio is going to be salary divided by the market value times 100. So it appears like 89. Okay, that what it means is the salary is 89% of the market value. All right, any comp textbooks are going to show that you take salary divided by the market value, and that gets you the market ratio, but you should multiply it by 100 to get a whole number, just because it's easier to say 89 than to say 89%, or to say 0.89. Just say 89, it's easier. All right, now if I wanted to take the average of all of these market values, it's going to give me an error message. Why? Because this case, it's trying to divide the salary by something that's not there, so you get an error message, and that causes an error message here in my aggregate statistic. So I use if error equals if ERROR, open parenthesis, comma, double quote, close parenthesis, and copy that down all the way. And now my aggregate works. So this error message that used to be here, when I was younger, I would just delete that error message because it messes up my aggregate statistic. But now by using if error, you just wrap like this. I'll put it into chat. Okay, there's the formula. You have your formula, but you just wrap around it if error, and you put a parenthesis, and at the end you put 2 quotation marks and a closing parenthesis. That way, if a formula is going to result in an error, what it actually will display is just a blank cell. So it will allow you to average the remaining values. And someday, supposing you have a market value here, 16,000, then it'll give you a calculated market ratio. Okay, but I'm not going to do that. Okay, so we're paying 95% of market. Now we need midpoints. So what I do for midpoints is, what's the simplest idea of midpoints? The simplest idea of midpoints is use the market value. If your pay philosophy is to pay market competitive salaries, then for each grade, like grade 18, couldn't you just take the market values, these 2 numbers over here on the right, average them together? If you look here, you can see 21,881 down here, and make that the midpoint. That would be the simplest, most accurate market-based midpoint that you could come up with, right? Isn't that what we're trying to do, is have salary ranges that have midpoints where the midpoint represents the market. Yeah, and then minimum and max also represents the market, but the market's not a single number. The market is a big range of numbers. So by having a midpoint, that represents sort of the middle of the market. Max is like high in the market. Minimum is like really low in the market. Some companies even tie this to the 90th and to the 10th percentile. One of my previous companies did that. So the midpoint should align to the market value. I could just simply take the average of these 2 numbers. For grade 17, I could take the average of these numbers. Grade 16, I could take the average of these numbers, okay, which is 14,796. Quick way to do that is a pivot table. So I'm going to insert a pivot table, and Excel is going to look up, down, right, and left from where my cursor was, and it's going to put the pivot table on an existing worksheet, and I want it to go here in the structure tab because I'm building a structure. So where does it go? It goes right here. I already have a pivot table there. So I'm going to go here. I'm going to get rid of all this stuff right now. Okay. So this is my pivot table. I'm going to just hit refresh. Okay, because it changed a little bit. Grade 18, 21,881. And that's the average of these 2 numbers, 21,881. All right, grade 16, average of these numbers is 14,796. There it is, 14,796. So these are the average of the market values by grade. All right, so I'm just going to make these into midpoints. I'm just going to take these numbers, copy, paste, like that. And then my midpoint is currently looking at column J. I'm going to drag this over to E and copy this down. And it calculates out the min and the max using, I'm going to change this also to 0.75 and 1.25. That's going to give me a salary range spread of plus minus 25%. That's not a correct or incorrect number. It's just for example. In Singapore, I can tell you it's very popular and common to use plus minus 20%. Same in the US. This would be for very, I would say, mature economies with mature education systems. So the supply and demand of talent, the economy and the education system clears the market. The demand for talent is satisfied by the supply of talent. And so the salary is pretty stable. In developing countries or countries where there is extreme competition for talent at times, or an overabundance of talent at times, you need wider ranges. In China, in Philippines, Indonesia, Thailand, you need very wide ranges, even plus minus 40%. Okay, so that's a different discussion. So that's what I've got using the market values as midpoints. Okay, those are the market values right there. Now, notice you can see visually that this is a what I call a bumpy looking salary range structure. Okay, the ranges go up, and then they actually go down, grade 6 to grade 7. You see right here, grade 6 to grade 7, the numbers go down. They actually go down 0.98, almost 10%, from 16 to 14 something. All right, and then they go up, and then they go up a lot, and then they go up mildly, and then they go up a big jump here, and then a small jump, and then a big jump. When you look at the structure fit, how the ranges wrap around the salaries, you can see that the structure is bumpy. It's not smooth, okay? But you have to admit that these midpoints are very accurate to the market because you literally are using the average market by grade for the jobs in each grade. Okay, so that's how I would develop a non-regressed, unregressed salary range structure and use these as my midpoints. Okay, and if I look at the ranges now, if I bring in the midpoint, I can say equals VLOOKUP. I can look up the grade number in salary ranges. Click on salary ranges. Whoops. Oops. What did I do? I have to go 3 like that. There we go. 21,881. Okay, 21,881. That's the range midpoint. Then I can calculate compa ratio, and that's going to be this time salary divided by midpoint. Now you do need to know what a compa ratio is for the exam. So this is where we're calculating compa ratio. The salary, 20,000, is 91% of the market, which is 21,881. All right, and if I copy that down, everybody has a compa ratio. Okay, a really high compa ratio, like here, this is kind of high, 108. The salary must be higher than the market, 17 versus 14,796. Now, what's the average? I'm just going to copy this formula from here to there. salaries are 95% of market on average, and salaries are 94% of midpoint on average. They're very close, and they should be, because the midpoints are based directly on the market values. All we've done is average together the market values by grade. So these two are the same. These two are the same. These 5 are the same. Whereas these are a little bit, different job to job. Okay. All right. So I'm sorry I'm moving fast, but this is just to refresh your minds on how we work with structures and some of the concepts. Notice one thing, this job is not matched. Some companies don't even have midpoints. They simply use market ratio as a comparatio for the merit increase. Some companies just use market ratio. They do benchmarking. That's fine if you have a market match for every job. If you don't use midpoints and you don't have ranges, or they're very out of date, then you have an alternative. You can simply use market ratio, salary divided by the market value. But that puts pressure on you to have a market value for every job. And if you don't, then you can slot this job to another job. Just say, oh, whatever this job is, that's what I'm going to use here. This is just equal to this. You find a similar job, let's say this job down here, and you just make it equal. Okay, the nice thing about having salary ranges is every job doesn't have to have a benchmark market value. You can have some blanks like this, and it's okay, because as long as you know the grade of this job, it's a grade 16, you can just use the grade 16 midpoint. So you don't have to benchmark every single job. Not every job has a market match. But if you develop salary ranges, every job is in a grade, every grade has a range with a midpoint. So you can calculate comparatio for everybody, even where their job has not been benchmarked. Okay. There's some other methods on structures. What if you want to make this smooth and have a consistent percentage rise, midpoint to midpoint? Okay, so what I would do is I would take these numbers and copy them here, paste them here as values. But the pop-up says you copy paste, highlight them all, and then use fill series growth trend. And it's going to perform a regression on that set of numbers to smooth them in a consistent percentage growth. Fill series growth trend. It took me a long time to discover this in Excel. So if I highlight these, I go here on the home menu under editing. There it is, fill, you see that? Fill series growth trend. Hit OK, and the numbers will all change. 1182 went down to 862. Whoa, that went way down. That scares me, because what if there's a minimum wage down there and I've just gone below minimum wage? That scares me. This number up here didn't change very much. This number went up a bit. This number went up a lot. This number went up enormously also. So the numbers moved around. Now, what if I point my midpoints to this column and copy this down, and everything recalculates? Now my midpoint progression is 26% between every grade. And if I look at the structure graphically, it looks nice and smooth. Yeah, looks really nice. Go to structure fit, and now it's curved and looks very nice, although I have a lot of people below minimum over here now. Okay, and my comparatio is a little different now. It's 92. Because why? Because regression, the good thing is it gives me a smooth line. The bad thing is those midpoints have to move quite a bit in some cases. Over here, these numbers moved quite a bit. What's the difference? Equals this divided by this minus 1. And I've formatted it a certain way. And you can see that this number went up 41% from 1540 to 2175. So my jobs in grade 8 have a market value of 1,540. But for the sake of having a smooth progression, this number has to go up to 2175, 41% higher. My midpoint, 2175, is 41% higher than the actual market value for jobs in that grade. Which means if I use this structure, even though it looks nice, it's nice and curved, but it's not accurate in grade 8. This midpoint of 2175 is more than $500 too high. It's like 40% too high compared to the actual market value for jobs in that grade. So we're going to be overpaying people here if we just simply use the midpoint as a guide, right? And yeah, you're going to have some outliers down here. You still have a few outliers up there. And so that's that. So there's some other methods that we can use, such as anchoring. I like to anchor this number to that number. And especially if I have a minimum wage concern, I do not want regression to drop my number so much. If I anchor this number to equal this one, then that helps. Maybe I'm going to anchor this number also because it went up by 41%. So I'm going to tie it to there. We'll be done in just about 5 minutes. So if I were to regress from here to here and use fill, series, growth, trend, hit OK. And then I'm just going to format the numbers that I regressed. Okay, and now I'm going to regress between here and here. Fill, series, growth, trend. Okay, this is all in the YouTube video. You have the URL to go check it out on YouTube. So if I use these numbers for my midpoints, all right, these are smooth, 6.8%. It's a flat progression. It's not very steep. But here is very steep, 30% grade to grade. But at least it's smooth. It's smooth from here to here, and then it's smooth from here to here, but using different percentages. The structure fit is better on the low end. It's still a little bit low up here, but at least I don't have so many people below down here. All right, and then check my compa ratio. Boy, it went up a little bit because we're starting to manually, manipulate the range a little bit to avoid too much creep based on the regression. So here I can say equals, how much did it change? This one divided by this one, minus 1. Okay, that didn't change because that was my anchor. Okay, so I don't have like 41%, okay, which was very extreme before, but I do have minus 28. So if I do it again, I might anchor this one. Okay, so I use anchors to really tie my range structure to this number, to this number. Okay, I don't want the regression to push those numbers so far away from the true market number, okay? So I use, typically when I do structures, 2 or 3 or 4 anchors, all right? 2 or 3 or 4 anchors, right? If you're hanging your sheets out to dry, you don't want the wind to blow them away, you use clothespins, and you might use 2 or 3 or 4 clothespins to attach it. And that's just what I'm doing because regression pushes your midpoints away from the true market numbers for the sake of a curved line. So, okay, that's all I have time to show here, but I'll stop sharing. And that is to give you a quick refresher on how we work with market data, employee data, matching, aging, year-over-year analysis, and range midpoints, and some basic modeling. So next week, what we'll do is we will go to the PowerPoint, and it'll go much more smoothly, because when I talk about compare ratios, you know what we're talking about. When I talk about updating the ranges, you know what we're talking about. Does it make sense? Any questions? We have a few minutes here, so we could just take some questions.
Some small question. You said about wider range. Wider range means starting from 75% to 125%. Usually we set mean and max 80, 120.
80 and 120. Okay, is that
Yes.
common in Bangladesh, you say?
Yeah.
Okay.
So you said about 75 and 125. So what is the is it used? I mean, in other countries?
Yeah, it really varies by country. Plus, 80 and 120 is also very common in the US and in Singapore and in much of Europe. Because I would say these are probably, I don't know, mature enough economies. And if you can manage to a tight pattern, a tight range, well, that's good. That's good, because you don't have such extreme, pay inequities, right? You don't have such big differences for people in the same grade. That's good. However, it doesn't work in Thailand. Thailand, I asked participants in the CTRP, why is the P90 50% above P50? And why is P10, 10th percentile, 40% below? They said, that's how it is. They said, in Thailand, two people doing the same job can have salaries that are so different. One person is making twice as much as the other person. I couldn't believe it, but I've had multiple Thai participants tell me that that's, that can happen. Philippines, similar thing can happen. China, a similar thing can happen. So it does vary by country. I like to take the market data file and take a sample of jobs, and I simply compare the P10 number to the 50th median to measure how far below the median the P10 is. And in Singapore, it's minus 20%. So minus 20% in Singapore gets you to the 10th percentile. But the 90th percentile is not plus 20, it's actually plus 30. So if you want to go from the 10th to the 30th, you actually have to go down 20% and up 30%. You might want to do such an analysis for Bangladesh. If you have a file for Bangladesh data, maybe it's a couple years old and you don't mind sharing it with me, I can do that and check to see like how far down is the P10 from P50 and how far up is P90. It's not symmetrical. It might be down 20, up 30, like Singapore. But that's the analysis I've done because I want to know where my min is and where my max is relative to the market. I'd like to know, is it at the 75th or is it at the 90th? Where is it? Yeah. So there's no one correct answer, but I think it's important to know how much of the market your salary range covers. Does it stop at P60, P70, P80, P90? Where does it stop? And you cannot pay beyond that. You should know. Any other questions? Otherwise, we'll call it a day and let you go.